The competitive advantage today, capital, I believe, flows a lot more freely than it ever has before to the best ideas. But you have to execute and you have to keep executing.
This podcast is for advisor use only and not to be distributed to the public. The Wealth Consulting Group is an SEC registered investment advisor, and the opinions voiced and contents in this podcast are for general information only and are not intended to provide specific advice or recommendations for any individual. All performance referenced is historical and is no guarantee of future results. All indices are unmanaged and may not be invested into directly. The economic forecasts set forth in this material may not develop as predicted, and there can be no guarantee that strategies promoted will be successful.
Welcome to the Bull of Wall Street. We are so happy to have Ashim Mehra joining us. Ashim is the portfolio manager for the Baron Technology Fund. I'm also joined by my co-host Talley Leger. And Ashim, this is so nice to have you. Last time I saw you in New York back in November, and we were getting ready to find out who the president was going to be. So a lot's happened between now and then.
I think that's an understatement. Investing in technology, we are literally at the fire hose every single day. And so between politics and AI, it's been quite a year that we've been through. But lovely to see you again, and thank you for having me on.
Yeah, so we talked a little bit last week about kind of positioning and talked a little bit. I guess we could jump right in about AI, since that's really kind of your wheelhouse. I feel like, and I'm not an expert here, but I feel like a lot has happened even between the beginning of the year and now, and even from the time that, we had that first, chat GPT going live and adding, I think it was 100 million subscribers in a very short period of time. And it feels like back then it was really, really good, but it's gotten better. Like every 6 months, I feel like it's getting a lot better. What do you think about all of that's happening?
Yeah, I think there's the amount of change that we are seeing in a abbreviated period of time. My co-portfolio manager, Mike Lippert, and I talk about literally every day is unprecedented. And I think our ability to keep up with it is also just challenging. Just literally, you come to work every single day, and there are major announcements. And this month is no exception in terms of the announcements you've seen from Oracle and OpenAI and others. So, maybe just to kind of set a frame of reference, I very much grew up in the time of the dot-com, and the internet was a huge change agent and really change in distribution more than anything else. But then there was the infrastructure that kind of underlaid it, if you will. The top of the pyramid was the application, but the internet, the networking, the hardware, and the connectivity was what enabled it. And similarly, we have a similar framework, and I don't think there's anything um, uh, uh, that other people don't think about in this respect, but we think about it as the base layer of AI kind of being networking, semiconductors, hardware, um, and that remains. Some of it has changed in terms of the hardware, obviously, companies like Nvidia and others. The next layer we look at is kind of what we call the model layer, and obviously you've heard of ChatGPT and Anthropic and Grok from Elon, and we have at least five, and Gemini from Google, and we have at least five companies in the U.S., one in France. We'll see if we have others, one or two, definitely two in China, and so we have this model layer, which quite candidly, other than a small investment in Grok in one of our funds or a few of our funds, uh, we're still questioning where the competitive advantage will be in that layer. We believe that obviously cost and efficiency matter, but the differentiation, I think, is still being determined on how different is one from the other. And then the last layer is the application layer. And that's where you see today ChatGPT, the consumer-facing apps, right?
Mm.
Meta with Meta AI, um, um, Anthropic in a B2B sense, but less consumer facing. And then just other applications, maybe things you wouldn't think of, things like Duolingo, for example, where you're actually using AI to speak with someone to learn a foreign language, right? That
Mm.
wasn't happening 1 or 2 years ago. And so we're seeing a lot of the application side of that as well. And so all of those are moving at a frenetic pace. The demand signals from the hyperscalers and the clouds and what we call the neo clouds, which are companies like CoreWeave,
Mm.
are that the demand for their services is insatiable in the short term. And they're actually seeing an acceleration in, again, the short to medium term, meaning this year and into next year. And I think if we look back to a year ago, we had an idea of where we thought demand could go, and that has been kind of even upsized from where we thought a year ago, and it continues to surprise us how much demand there is in the short to medium term.
Mm.
I think longer term, there's still a question in terms of some of these deals that are being announced from by people like Oracle, and how much of it is really contracted to be built out, and how much of it is built on we believe we will need that demand. And I think
Mm.
that's a process we're going through. But the changes, to your point, like the internet era, the speed at which it's happening is
Mm.
faster. The companies are real. The products are real. To your point, ChatGPT is, approaching 1 billion users, not quite there yet, but
Mm.
approaching that. And so the type of applications we are starting to see, though still early, are also indicative of there being, real applications for all of this.
Wow.
Hey, Ashim, can I jump in here? I got a
Please, anytime.
question. Yeah. So, because we started with the big issues first, and that's great. And you're amongst friends here, because we're
Thank you.
technology bulls. So this is great to talk to you. So you went back to the internet days, and I kind of want to go back there too. So that was, I guess, Netscape launched in '94, and I was in college at the time, and the TMT bubble kind of inflated up into 2000, and I think back to those times, and I try to use it as a blueprint for what could happen from here going forward. And even at that time, I was at Morgan Stanley when I started my career, and our wildly optimistic internet analyst was Mary Meeker,
Yeah.
and very mixed feelings about that analyst. But even the most bullish person on Wall Street, I don't think foresaw in all of our creativity and our imaginations how connected we are today with Wi-Fi, and how we're using internet and all of these wireless devices, and the streaming, the content, 4K, and the screens, and so,
Mhm.
of course, markets discount all that stuff. This is 25 years later now, and they get way over their skis, as we know, as practitioners. So fast forward to 2025. I kind of foresee, this is kind of bubble analysis at its finest, supported by very real things. We understand revenues and earnings and investments, but what is the thing that you can foresee in your mind and your creativity that investors are not fully appreciating? How crazy could this thing get in the decades to come? And I'm talking about AI and how we're just kind of scratching the surface here with these technologies.
Yeah. Having lived through, I was at a startup in that dot-com period, so I wrote it up and down. So I have the scars to prove it.
Yes.
So I am, and we are at Barron, and really, I should say first and foremost that I work with a team of colleagues who, there's about three people on our semiconductor team, and another three on internet, another three on software, and then other folks on energy and industrial. So we have a very broad team that focuses on technology, and I'm the beneficiary of a lot of smarter people than I that I get to work with. So I think we struggle with this question. It took us about 6 minutes into this podcast for the word bubble to come up. So I was waiting for that. So we do worry. We have a couple. I have a couple of thoughts on it, and I, I I do agree with you that in the very long term, that this is um, a generational technology, and it is very meaningful. I think what we have to be careful about is nothing, at least in my life, maybe you guys have been luckier than me, goes straight up to the right ever. Um, there's always a moment of digestion, of pause, of saying, wait, what is the return on the investment
Mm.
that we are putting in, and are we over investing too quickly? And that's what we're, if we have a caution or a yellow flag, that's what we worry about. And quite honestly, our fund this year has underperformed because our exposure to AI infrastructure relative to other technology funds is a little more balanced. We have a little more on the application layer in companies like Duolingo, and we've managed our exposure to, how much we want to have exposure to all of the AI infrastructure. But what we should recognize is a couple of things. One, that OpenAI is driving a lot of the dialogue around incremental demand. Okay, it's one company. They have a build out with Microsoft Azure, another one with Oracle and SoftBank as far as Stargate, and now as recently as last week they announced a third one directly with for 10 gigawatts with OpenAI, sorry, with Nvidia, and 1 gigawatt roughly, sorry, that's 10 gigawatts, and that roughly can be 350-ish, 350 billion dollars of revenue just to Nvidia.
Mm.
So we have to keep in perspective what and who is driving that narrative. Okay, so we're very dependent on one company driving a lot of that. Not that saying that Google and others don't want them, but they want it for their enterprise and
Mm.
less just for their self. So there's no question there's a massive build out. Uh, I think there are a couple of questions. Will closed source versus open source win? Um, and what are the economics when you have five companies going
Mm.
after one prize?
Mm.
There was a very smart investor from the dot-com time period, a guy named John Stanton at a firm called Trinity Ventures. And he was closely associated with Macaw and that whole Macaw Cellular, if you remember them. And he talked about the fact that when you have four or five companies competing for one economic
Mm.
pool, no matter how large, even if we're talking in the trillions, which I believe we are in terms of
Mm.
the long-term profit pool,
Mm.
that profit pool gets diminished when you have multiple companies competing for it.
Mm.
And I think you have to think about that in the context on this. Look, Jensen frames this as a $3 to $5 trillion opportunity. One way, there's many ways to arrive at it. One way to arrive at it is there's a billion knowledge workers in the world, and would they pay $5,000, or the companies pay $5,000
Mm.
a year to get, anywhere from 30 to 50% productivity in time for them? And I think that's one framing. There's
Mm.
multiple. Alibaba as recently as last week, talking about how quickly these data points come out, has said they want to increase the data center power, and power is an indicator of compute over time, and enough demand 10x in the next 5 years.
Mm.
So, you know, what worries us today is you have $20 billion in revenue. That's growing to maybe a much bigger number by the end of the year. Um, and Jensen says maybe it's 100 billion in revenue next year.
Mm. Wow.
We're closer to 50 billion. So we have a more nuanced, maybe a slightly more conservative view of the world. Not overly conservative, but I think a little more balanced, if you will. And I think generally you have to discount some of the really big numbers out there. I mean,
Yeah.
Jensen talks about 3 trillion revenue opportunity, but the sell side, for example, has 8% growth for Nvidia beyond from 28 to 2030.
Mm.
Well, if Nvidia is going to grow 8%, 28 to 2030, this is all not going to work out.
Right.
So we believe those numbers are likely higher, but do
Yeah.
we need those numbers to, be, we think Nvidia and the data center business will do roughly 250 billion dollars in revenue next year. And we think it can
Mm.
come close to, doubling that number in the 5 years that follow, right? And so our numbers are not as aggressive, but we still think we can make a lot of money even with those slightly more conservative numbers, if you will. And you do have, you do see the return. You see what Meta is doing in terms of the incremental revenue that they are driving. We still think a lot of the capex going into Meta is not actually for the advertising business. We think it's
Mm.
for generative AI. But you do see that the return that they're able to get advertisers on just how much better targeted an ad is,
Mm.
how much the creative can be adapted to the consumer on a one-on-one almost basis at this point. So there are returns that you see. Um, and anything today that's bottlenecked by intelligence, right? And these models already, you don't need a lot more iterations. A lot of them already at PhD levels of math, they can do a lot. I mean, medicine is one of the areas we're very bullish on long term. Not a lot of ways to play it immediately. We have a small company in our portfolio that we invested in recently, for example, um, that takes MRIs and does an overlay, almost like a software overlay for the heart, and looks at the flows of uh, with that MRI, and then does an AI-based, more nuanced evaluation of it. And so that's a very basic thing. But we've also met with entrepreneurs who are building, pesticides literally from scratch based on these. And you think in the medical field, if you think of how many more medical compounds they can arrive at, but you don't have to just arrive at it, then you have to test it with robotics in a
Mm.
lab to see what the results are. And by the way, a negative result is also data that can be used to then feed the model to say, okay, hey, that didn't work, and maybe this is why this didn't work. So you have to combine the theoretical and the data-based world with the physical world in the case of biology or chemistry, and bring those together. So we think there's a lot
Yeah.
happening. Um, in that field as well. So it is a very exciting time. We are very positive, but we think, I believe that medicine, and we believe that medicine is one of many areas. We've talked, robotics. We can talk about clearly Tesla with cars. We think that's another area where virtually, most cars will be autonomous and electric at some point in time. So these are huge markets, and it's going to take decades for much of this to play out. And so I think we just want to recognize that there are opportunities in the market today that are very compelling. And then the same AI is going to create disruptive technology. So
Mhm.
if we think, electricity is an easy one. People believe we're at, we need anywhere from, and literally the estimates are all over the place. The common belief is that we need an extra 80 to 100 gigawatts of power in the next 5 years. But that doesn't necessarily take into account what can AI itself and science do in that
Mm.
time to make the chips more efficient, to make the data centers more efficient. That maybe we will need that. Maybe we'll need a little less, and we're playing power a little bit differently, and we can talk about that if you guys want.
So you just very helpful the way you framed out the numbers. And so I think even the more skeptical economists amongst us, they look at the current landscape and they reason, well, okay, we're seeing negative return on investments, and this is just a group of mega tech enabled companies, call it 5 to 10 companies that are kind of just using their cash to invest in each other, a bit of a shell game. But you're saying, well, yeah, contrast those tens, hundreds of billions of dollars of investments that are being made. Maybe, yeah, you're right. The revenues now are in the lower single billions of dollars, but just give it time is what I'm hearing. And
Yeah,
they'll pay off in the years to come, the decades to come.
yeah, yeah. I think that's right. I think what you have to be careful about is that the expectations from investors may be that that comes in a linear way, that the revenue will be linear. And what we might see is that there may be a pause and the revenue might not be linear. In the long
Mm.
term, yes, I think it will all prove out. But in the short to medium term, you really have to watch where, at a stock by stock level, where are expectations, and where are
Mm.
expectations, and what are expectations based on, right? And I think that's where we have to be careful. But in the long term, yes, I completely agree with you. And so that's how we think about it. I mean, take Oracle for example. Oracle is going to have to raise or finance, um, if it fulfills the deal with OpenAI. We believe that they will require roughly $240 billion to deploy into capital expenditures. That's not on their balance sheet today. That's something they're going to have to go out and finance. And today, as we saw last week with OpenAI approached, again, this is, I should say, this is not a fact from what we understand and have read, just like you. Our understanding is that OpenAI approached Nvidia for the financing because they said, hey, probably said, we're going to have to raise financing several times. By the way, what are we going to do with most of that financing is buy these guys GPUs anyway. Why don't we just
Yeah.
approach them? And I get the skepticism. I completely understand the skepticism. And I think I don't like it as much as the next person. But there's not a lot of people who are going to be generating $100 billion of free cash flow
Right.
in the world. And Nvidia happens to be one of a very, very short list of companies that has that kind of balance sheet. And is going to be making a product. So I get it, and I think we will see the cadence of how much comes out each year, and because OpenAI also needs to generate substantial amount of revenue. Our guess is that maybe they'll do 13 billion this year, maybe 30 billion next year. Maybe Anthropic is another 10 billion, and XAI maybe in that ballpark. Maybe again, just these are complete guesstimates. So yeah, I think so. As you see these dollars come, the capex will come, but sometimes needs to be spent ahead of time, and that's where Nvidia kind of fills the role.
And I apologize. I shouldn't have said bubble. It's really, I think mania is a better word for it because bubble
It's
implies
fine.
nothing but air, right? And I don't think that's what it is. This is a lot of money we're talking about. This
It's
is
well, and a lot is real
Unprecedented.
earnings, real profit. But there probably are, I'm sure, Ashim, pockets of froth that companies that are going up a lot that you're probably like, I'm going to pass on that.
Yes. If you want me to comment on which areas, I can, but there are areas that we are not investing into
Yeah,
because we think these are companies that won't generate any cash flow for 5 to 10 years, best
sure.
case scenario. And we think that a lot of these companies, the science is not like you have maybe an experiment that works, but none of these companies have produced at any level of scale. And what we found the hard way over time is producing for scale and getting one or two or five of something to work is very different things.
So could you talk, spend a few minutes? I'm curious about disruption and speed of disruption, because I feel like we're in this whole new phase where, we had the internet and it was like, if you had your company out on the internet, then you're competing, but now I feel like we're getting to new levels of, table stakes. What do you have? How do you do it? And like, how are you using AI? And I'm just curious, with, Tesla's doing self-driving cars. And by the way, I've rode in many Teslas before, Uber rides. I don't own one, but lots of Uber rides. But for the first time the other day, I was heading to the airport and I sat in the passenger side in the front, and the driver had it fully autonomous. It was the first time me seeing that. I'm sure you've probably seen that, but like, it's amazing that, he didn't touch the steering wheel. He didn't touch the brake or anything, but he had to like be aware. I guess the system needs to make sure that he's paying attention. He's not sleeping. So, I mean, that's pretty amazing. But like when I think of quantum and training, all the stuff that we're doing to train and get the right data, get the garbage out and clean it up, and then inference gets better. Do you think that like we'll get to this, what is it, AGI, artificial general intelligence? You think we'll get there quicker? Some people say it's going to take a long time, but it seems like we're getting there, like maybe quicker. What do you think of all this? And does quantum play a role to speed it up? It's a lot. I'm sorry.
Okay,
and the plane, Jim.
I'll start with what you started with, which is, and we'll end with AGI. I'll start with where you started, which was the speed at which um, innovation is happening. When we started this fund 3 years ago, Barron is known for three things. If I had to summarize, we're known to be investors in exceptional management, not good, not great, but really exceptional. We are known to invest in really competitively advantaged business models, and we're known to be long-term investors. So our turnover is relatively low. A little harder to do in technology, but still, that's an understatement. So that the reason why our firm has done so well investing um, in Elon so early,
Mm,
regardless of your political views on him,
yeah.
which I, won't even touch that with a 10-foot pole. But regardless of that, um, the pace at which his companies innovate, if you've either read the book about him,
Hmm.
um, is unparalleled. And the empowerment that the employees have to innovate and to take that innovation and bring it system wide throughout the company is also unprecedented. And I think so. You have to look today through that lens of competitive advantage. How quickly can you innovate? Do you have the people? So, again, back to people. Do you have the people who are built to innovate, or are they built to say, hey, I'm done. This is good enough, and that's okay. The competitive advantage today, capital flees. I believe flows a lot more freely than it ever has before to the best ideas. But you have to execute, and you have to keep executing, and that culture of continuous improvement is, I believe, today what's very, very different. Now apply that to AI, right? If you think about what another way of AI, thinking about AI is scaling laws. And scaling laws are really what they do is they describe how an AI model performs as it improves with its size, right? So relative to the computation it takes, how much better does it get?
Hmm.
And there are three kind of scaling laws. One is pre-training, so before you train. One is post-training, and now inference, which is kind of kind of integrated into something called reinforcement learning. So, which means the longer you think, the longer the model thinks, the better quality answer you get.
Mm,
And while it's thinking, it's going and checking and getting even more information. It's firing off other agents to get even more information to come back with an even more complete, more intelligent answer. And agents take up even more compute. So if you think about this whole theme that we've just been talking about, which is improvement, continuous improvement,
hmm.
and I'm an industrial engineer by training. There's a word called Kaizen that was invented by the
Oh
Japanese a
yeah.
long time ago, just
Yeah.
continuous improvement. That's really what AI is doing. It's improving constantly the
Hmm.
accuracy. Now, if you think about what that means in the world going forward, the hardest thing to do with AI, so take Tesla or anyone in that world in terms of autonomous driving, the hardest thing to do for them is corner cases. Corner cases means
Mm,
the exception. You and I could drive the same route every day
hmm.
in perfect weather and never have an issue. But one day there could be I'm making it up, but there could be
Mm, yeah.
construction, or there could be a lightning storm, or a rainstorm. And how does it deal with this construction and rain and this mix of factors? Those
Hmm.
corner cases are what AI has to sign for. So another way of saying the times where you don't believe that the answer is right and you see the hallucinations, which is another word of when AI clearly gets it wrong,
Hmm.
the rate of errors has to come down meaningfully for you to trust it. And so
Hmm.
inside of enterprises, they will use sometimes something called a RAG model, or effectively they will feed it just information that they know to be very factually correct. And so in those very niche use cases, or may not be niche, but in those very specific use cases, it works perfectly or works much more accurately. Um, But in the case of driving, the use cases are vast, and you need to figure out that last case.
Yeah.
I think in the same case of AGI, there are so many things you're trying to the number of use cases that you're trying to solve for is, it's superhuman intelligence means just that. So I think we're already approaching in some ways human intelligence, but like to be superhuman, I don't know. It could take 5 years, it could take 10 years.
Yeah.
It could be a false god, but I think all the companies that are building these really large models are all chasing it because
Mm.
they believe that that prize is worth chasing, is worth spending all this money on, because if you're able to achieve that, then you are able to access those trillions of dollars of knowledge worker and make the workers either more efficient or, I think people don't like to say it, or have less workers. And I think they also view the competitive threat of not having it
Mm.
as being too large.
Right.
What if someone else has it? Then can they rebuild my company from effectively nothing? Because a lot of these very large companies also happen to have massive amounts of distribution, right? So
Mm.
they are definitely benefiting from that.
I think perhaps one of the most exciting things that you said, this is really, and you just touched on it. It's far beyond worker productivity. This is something that could transform many industries, and you named a lot of them, like robotics and the food that we eat, the quality of it, and
Yeah.
Healthcare. Yeah.
yeah, medicine, healthcare.
Hmm.
It's just mind blowing. But I wanted to come back. This is kind of a career question, and kind of how you, using your background, you pick some of these companies, and you touched on it. So I think you said in the '90s you founded a digital company, and then I noticed, because I cheated, I looked up your background before the episode. Then you went into institutional investing, and you were actually at RBC at the same time I was in the early aughts. I was up in Toronto doing global strategy. Were you in New York, Ashim?
But in New York, I work with a guy named David Beck, if you know
David
that
Beck.
name,
Okay, that
who's
actually
one of the
names,
software.
yeah, rings a bell. Yeah. So given that background, kind of the entrepreneurial experience, and then the move into sell side, institutional equity research. How does that experience kind of uniquely position you to evaluate tech companies today?
Um, I think there's two aspects to that. One is, and one is, I would say equally, I've learned from Ron, um, is to be an evaluator of people, right? That's a really
Mm.
hard thing to do. There's certain pattern recognition that I think Ron is really good at with people. I would say he's almost a savant in many ways with that respect. Uh, a lot of people are driven by something beyond themselves. It can be something that happened to them either in their youth, could be a traumatic experience, could be a chip on their shoulder, but they have something to prove that goes beyond, um, a number on a bank statement. Um, and identifying who those people are, why they are the way they are, and what makes them really special at that. Um, I think that is something you learn as an operator in terms of the people you hire, the people you start a company with, the people you take capital from, the type of integrity you look for, and we won't compromise on that. And not to say that I haven't made mistakes. I think you learn a lot from your mistakes, but I think that is one thing from my experience here with Ron and from operational experience that really makes sense. I think the other is understanding what a company looks like from the inside, and the human, not just the human, but what allows one company to execute and to scale versus others. And there is some pattern recognition there. So one of the things, we look for at times is people who've done it before. People who've done it before, if you talk to first time founders or CEOs, they're like, wow, there are so many mistakes I made. I can't believe how hard certain things were. And you talk to a second, or the CEO of CrowdStrike is a perfect example. He talks about like, wow, I already made all those mistakes. I know what mistakes not to make. I'm not going to make those again. And so when you meet second time founders, um, they already often have made the mistakes, know how to scale, know where um, the pitfalls are. And so those are two of the things I would say that really have helped. And then I think just, I spent a short period of time also doing consulting in between, and then and looking at companies and how they allocate capital. And it was a group that used the Holt framework, which Credit Suisse kind of came up with, and
Oh yeah.
basically looks at economic profit.
Mhm.
And we would go to companies and look at what of their businesses and what drove economic profit and what didn't. And I think the only part that analysis misses, to your point on ROI, return on invested capital earlier, was that if you looked at Amazon, it was terrible return on invested capital for years and years and years, and
Yeah.
so
Good
was
point.
Tesla.
Hmm.
And I think what companies today are doing is they're investing, they're effectively keeping their margins lower today to
Hmm.
invest for the future.
Mm.
And that is something we like to see. You just have to really, really test what is that future and what could it be like and why are these guys going to win? And that's where we spend a lot of our time diligencing who is going to win and why. And we have phenomenal analysts, including our analyst Isha Levin, who covers SpaceX and XAI and Tesla for us. So those have been probably the two things I would point to more than anything else.
Ashim, could we talk about just kind of what's happening with the world? Like we're less globalized. There's this deglobalization, and it feels kind of not exactly like the race between the U.S. and the Soviets with building nukes, but like it feels like there's kind of a race with AI, and like the U.S. government's kind of getting involved, and China's kind of doing their thing, and you got companies like Palantir that are trying to keep it secure and working with different government agencies. Do you see as this being something that different countries are kind of in a race? At some point, it would be nice that different countries can collaborate, but I feel like everyone's kind of holding it close to their vest. This is our technology. We spent the capital. What do you think about the future when you look at kind of where we could go in terms of all of that?
Oof. Look, the world honestly feels a little bit of a mess right now. Um, if you look at, try not to go look at some of these news sites just for that reason. It is such a polarized world, and that at a personal level makes me quite sad. Um, I do think that as we look at AI, um, the investments are largely happening in two regions, in the US
Mhm.
and in China. Those are really the two regions in the world. And those two superpowers, if you still want to call them that, are going to continue to compete there. I do think there are pockets in obviously the Middle East who wants to have a presence and invest against these technologies, and has a lot of capital to put to work, and maybe areas like Singapore and others. But for the most part, it's a two-party race, if you will. And I do think that because China is, I won't say starved, but let's say deficient on the amount of compute they would potentially like. They are, and I don't mean this in a negative way, it's a compliment. They are forced to compete with less resources. And that is something that the history of time, the underdog and the person who is really, really focused does pretty well. Now, I would also tell you that the majority, I believe this is right, um, of AI scientists are of Chinese origin. If they don't, both here and in the and obviously in China. And now they have actually made it difficult from my understanding. And listened to a podcast this weekend where I heard that some of the some of the guys who work in the DeepSeek model cannot actually they took away their passports, so they can't actually leave
Mm.
the country. So they
Wow.
understand that this is a real talent race,
Mm.
and they want to compete, and they have their national champions, and they will compete. And
Mm.
whether they build their own GPUs in time, how powerful they are, whether Nvidia gets approved, I don't know the answers to those questions, but I do know that they will compete and they will be a
Wow.
viable competitor. Um, I do think that Europe they have one model that's kind of their national champion, and ASML has invested in that recently, but I don't know that that is enough. Um, but the R&D is really happening here and in China, and I don't see that really changing.
Mm.
Um, so from that perspective, from an investing and AI perspective, I think the key technologies are largely here. Um, obviously TSMC is the leading manufacturer for semis in the world. I think the US administration is trying to do something with Intel and make it more viable. We shall see how that works out. Um, I think that's still very much in flux and in play, um, and an open question.
I have a
Do you,
macro question
oh,
for
I
you.
just sorry, Tal. I just one quick question. So, do you think other countries are going to have to go through the U.S. and China? I mean, are U.S. and China going to be like the gatekeepers for getting access to this technology, or are they going to find ways around it, or is it just not going to be as good?
I think it depends what you mean by technology. So the GPUs are restricted in many parts of the world, but largely
Mm-hmm.
in China. Uh, I think the Middle East will get access to compute either directly or indirectly through some of the cloud companies. So I think that's not likely to change. And I believe that outside of that, we will see not a lot more competition than those regions.
Interesting. So the cloud companies mainly, they're going to be the gatekeepers. So whether it's Alibaba or Oracle or
Or Nvidia,
Microsoft or Google or
or
Nvidia.
Google. Yeah, I
Interesting.
think Nvidia now kind of, I think you can think of it today as a chip company, but in the future, it's possible if they're going to build OpenAI's cloud for them, then why wouldn't
Wow.
they be, effectively? We don't think of them as a cloud company
Yeah.
today, but their margins are certainly better than many cloud companies.
Yeah. Interesting. Go ahead, Tally. Sorry.
No. I'm glad you asked that because it was on the same topic. But I wanted to ask a kind of broader macro question. I was at a conference on Thursday. It was a Simplify conference in New York. It was at the NICE actually. And one of the questions they asked the panel, Mike Green was on this panel, and it was about the one thing that could end the business cycle, and they wrestled with it. And so I asked a question to kind of lead the witness. And when you consider what business spending on technology right now is contributing to GDP growth, I mean, it's the bright spot in the economy. It's not a fantasy. It's actually happening. It's very real. And so the answer is tautologically, if you were to strip that out, you would be either at or in a recession. So my question to you as a tech expert is, looking down the road, years, maybe decades, and we've already talked about the hundreds of billions of dollars that are being invested and spent on tech capex. What could be the thing that brings the tech capex train to a halt, or at least slows it sharply?
There's a couple of things. Shortage of power could be one.
Mm.
That uh, the model efficiency or open source models from either China or the US that someone develops a level of efficiency that requires a lot less compute could be another. That's I think unlikely, but That could be another. Um, and then the third would be like if the revenues do not ramp
Mm,
as quickly as people would like to see, and there isn't an economic and viable way to pay for all of this compute. Um, I don't know, for example, if people in India, uh, well, I do know the majority, there's only a small percentage of the population outside of Western economies that can afford to pay $20 a month. And we see
Mm.
that with Netflix, Spotify, so on. And so um, then you have to monetize through advertising potentially. And then that's a slightly different scale. And so your costs matter. So someone like XAI, who is able to put up these very large clusters very quickly, very efficiently, um, even though it's largely the same hardware because they use first principles thinking, may have a cost advantage, or someone who's
Mm.
building on TPUs. I'm just as an example, as Google is with Broadcom, because the cost is lower, might have a
Mm.
cost advantage. I think, some of those things are um, to be determined, but I do think cost does have
mm,
uh, is some meaningful part of the equation here. And so you want to be able to do a lot of this very efficiently. And when we were just out in Silicon Valley and met with several venture capitalists, several companies, is a large group of us for the better part of a week. And yeah, it surprised me how many small companies were saying, "Hey, we start out with the open source. We start out with either GPT or Anthropic, one of these models, and now we've kind of got our own models, and they're a lot more cost effective." And so, if that becomes a trend for not that won't get you to AGI, but does do a lot of enterprises, and that becomes a very large trend, then that's not a huge positive for any of these cloud companies or necessarily even compute. So that's where I think we try and take a more balanced view. And one of the lessons we learned, I think, coming out of COVID, um, was that we wanted diversity in our portfolio and in correlations. So we really look for other trends that we can also invest against. And so, for example, we have a large investment in a company called Eternal in India.
Mm.
Eternal was known as Zomato, it was a food delivery company. Um, and food delivery is on its own not entirely exciting, but the fact is in India there's very little infrastructure for groceries, and now this company and it has real competition, so their grocery arm is called Blinkit, and now so they're doing grocery, and now not just grocery, electronics, and literally you can, and I have friends in India who literally can look at their phone, order something on Blinkit, and in less than 11 minutes it is at their house.
Oh,
That is
wow.
very, very disruptive. India is completely uncorrelated to U.S. equities, U.S. growth. When the U.S. market catches a cold, the Indian market is highly uncorrelated and also one of the best performing markets over the last 10 and 20 years. So we love when we can find companies like that that are less correlated to the business cycle, to your point. And we look to add some of that diversity um, into our portfolio. Obviously, it doesn't help us in periods like the last 6 months where it's like AI infrastructure and that's all that's going to work really, really well. So, but that's what we try and do as managers of risk.
So another thing I'm hearing is, and I like it, there's a silver lining to all of this cash burn and the scale of the investment and the infrastructure build out, and that is over time. And this, I'm a financial economist, so this is how I think about it very simply. The cost will become much more effective and efficient in the years to come, and that's to the benefit of the users of all of these fantastic technologies. So,
Let me give you two examples because for me, nothing makes it more real than companies actually using AI. So we have
Hmm.
two companies in the portfolios I'll just talk about. We have multiple at the application layer, which we think there's a lot of exciting things. We talk about the one that does analysis of hard flow, but another one is a company called Axon. I don't know if you've heard of them.
I
They
don't
started
know.
out many years ago doing tasers, and I didn't find that a particularly attractive business, but they started bundling that with body cameras and under a 3-year subscription. And I thought, wow, that's kind of an interesting business. We got involved, and then they started taking all the video from the body cameras and uploading it to the cloud.
Mm,
And then they started taking that and saying, okay, we can actually take the video and pre-populate a police report based on that body camera that's more accurate, that's faster. And by the way, policemen and women, the least favorite part of their job is typing a police
Right.
report. They typically type with 2 fingers, and they don't enjoy it, and they spend 40% of the
yeah.
time doing it. So here's a product that, was completely revolutionized
Wow.
police departments. They love it. And even they had very limited traction internationally before this. And now you have international because people were worried about sovereign clouds. And now, police departments around the world are coming to them and being like, hey, we want this product. And they're like, well, to take this product, you need to take the whole bundle of all the other products. And so
Hmm.
it's really, and now they also have drones that come as first responders. They have something called anti-drones. They're using AI in a very, very effective way. Their
Wow.
head of sales internationally is ex-AWS, AWS. Their head of product and CTO is ex-AWS. So they have, again, going back to the people making the changes, thinking about real applied uses for AI. And then another company I was talking just before we were speaking is a recent IPO company called Hinge Health. And so I'm in my early 50s, or I guess almost mid 50s now. And, I've had occasions where I've had a limb not work perfectly. And so here is you can put your phone, use their product, and literally it does physical therapy using your phone. It puts dots on your body, and it tells you in what direction to move your arms or your hands. And
Mm.
it says, okay, lower your shoulder, do it slower, and
Hmm.
all of that is based on AI. And if you think about the time it takes to go to a physical therapist, you probably
Yeah.
lose half an hour to an hour going.
Hmm.
Then you're there an hour, then you lose half an hour coming back. Now you can do this in the comfort of your home or your office any day. And it gets better and better, right?
What's
And
the app
per,
again?
it's called Hinge Health.
Hinge Health.
And they work through insurance plans to provide it to folks. And then they have a device, a TEMS device that provides like electric stimulation if you have a bad, a nerve or a bad back or whatever. So they have a hardware component to it also, which is controlled through your app or your phone. And then
You're
anytime
talking to
you
the
want
right
to,
people because you're in
right,
good company.
okay.
We're
And
in
then
our
if you
50s.
Right. So if you want to talk to, and then if you want to talk to a therapist or a doctor, you can. And so, but these are the applied uses of AI
Mm.
that I don't think get enough
Yeah.
of really the airplay or enough time in terms of how these companies are changing everyday behavior.
Yeah. Let me ask you guys. Let me ask you, Ashim, about how you guys use AI, but not just AI, but like you mentioned Baron and the people. I know you have a really good process. You're not like a massive investment firm like Fidelity or BlackRock. You're not that big, but you've done really, really well. The performance has been great.
Thank you.
Um, and you're unique. You're not just kind of like benchmark huggers. You guys will go and go where areas where people, a lot of them don't know about. I mean, you were some of the first investors with Elon back before Tesla was popular, and so like that's interesting. And I know I was looking at some of your other funds. I've spoken with Ron a few times, with Laird, Randy, yourself. There's been others. I noticed one of your funds, I think Ron's fund that he co-manages, it's a growth fund, but you have a lot of financials in there. I think that's awesome. So can you speak a little bit to just like how you collaborate as a firm, how you come across these great ideas and how you've been able to perform so well? I know you mentioned that like your three pillars, but like just curious to learn a little bit more about that.
Yeah, I would go back to those three pillars. I mean, every investment, every portfolio manager at Barron is focused on finding companies that are competitively advantaged. We are not right all the time, or even um, even uh, we're wrong plenty. But competitively advantaged companies that have really exceptional management leaders, and then again, companies that we can invest for the long term. But that is the tenet. But um, we have great people. To Ron's credit, the
Mm,
same way you look for a management team that is exceptional is how Ron hires. We have really exceptional analysts. I mentioned our analyst who covers a lot of the Elon related companies. Ishai does incredibly granular
mm,
work. Um, and we replicate that across a research team that's 50 plus. That's a lot of data, and we are growth specialists. We don't try to do everything, right? We are not
mhm.
value, we are not fixed income,
Sure.
we are growth. And there's a lot of companies, when you think about the universe, that are not competitively advantaged. A lot of companies that we think are maybe in the current market environment, um, that we don't believe that there won't be cash flow for 5 to 10 years. And even
Mm,
then, we're not sure that there's nothing we can look at today that would tell us this is going to be an interesting investment. So those filters and that process and the people who then fulfill it is, I think, the key as to why Barron um, has been really innovative in terms of the companies we invest in.
mhm,
Also, we have a history in small cap. The firm started in small cap, and I think that helps us identify a lot of these companies earlier. For example, um, Axon, we were just talking about, was
mhm.
owned in our discovery fund by Laird and Randy,
Oh,
and
yeah.
we were involved later, and we said, "Wow, this is a really cool company. How come
Interesting.
we aren't involved? We should get to know this company." And so there's plenty of cross-pollination between the funds in terms of ideas, and we're always pushing each other to look at other interesting areas where we may not be invested. But it starts and ends with the people.
Ashim,
Yeah, that
so
makes sense.
I'm hearing you're talking about financials, maybe that's fintech, and you're kind of down the size curve in mid cap companies. Do you find it in this environment? We deal with this all the time in our conversations. Narrow market, concentration risk, mega cap tech companies. Oh, how do you deal with that kind of objection or challenge in your business day to day?
Yeah, look, it's difficult when you are in concentrated markets, when the largest companies in the world are driving so much of the return.
Mhm.
I I am a believer in trends, but I also believe, as I said earlier, that nothing continues forever.
Mm,
And I do think we were at a point in time a few months ago where small and mid caps had been kind of left behind. Now,
Mhm.
in our portfolio, we don't manage to a cap range. We're really bottoms up stock pickers. So,
right.
for
Mhm.
example, we have 40% small and mid cap exposure in this portfolio, whereas most of
Mm,
our peers are at 10 or 11%. And so, um, but we're really trying to look out 5 years and find companies where we think stocks could double by putting a reasonable multiple on free cash flow.
sure.
But to answer your question, I think what we're looking for are those companies that are going to be the next, mid cap or eventually large cap. And that small cap exposure, that history has helped us to identify which of those companies are special, have the potential to be special. And look, we're uh, sometimes there was a recent white paper or paper that came out from Mobison, who's, you guys probably know, one of the better writers on investing over the last 10, 20 years. And Michael Mobison said, look,
Yeah.
all growth companies in their timeline of being growth companies 10, 20 years have multiple, I think he used 65% drawdowns on average. Okay.
Mhm.
Now, if you're going to have companies, and everyone is going to have them in their portfolios that have those kind of drawdowns, wouldn't you rather be the companies that are more competitively advantaged, that have the exceptional management teams? Because the companies that did rebounded several 100% and outperformed the
Mm,
companies that didn't. And so I think that um, that discipline, the pattern recognition that we see of those types of founders, those companies, uh, that's how we look at it. But it's hard to navigate. It is difficult to navigate when you have companies that because of either retail flows and excitement about a particular company for a period of time, go from small to mid and then go right back from mid to small. And one company can cause a small cap fund to relatively underperform the benchmark for a period of time. And so, but that's the new normal world we live in. And we don't optimize for that. We optimize for the long term and what do the returns look like over 3, 5, and longer periods of time.
So this has been fantastic, Ashim. We really, really appreciate your time with us. I only have one more question, and
Please.
I don't know if Talley has anywhere.
I got one.
Yeah. So for you, and just in your experience over the last 20, 25 years of doing this, do you feel like it's easier to pick stocks, or is it more difficult, or is it about the same? What would you say?
I think it's probably about the same. I think the things that are different is the amount of data that you have to um, digest on a daily basis
Yeah.
is multifold what you had to digest. And I think the volatility you have to digest in some cases in growth stocks is also probably more than it used to be. Uh, but I think other than that, it's the same. So you have to have a more you have to have a stronger stomach to for when you do have drawdowns and know that your thesis is unchanged. And I think there's a real-time element of data that in some of the companies that is like real-time companies, there's third parties that are tracking, not only doing transcripts every other day or week with
Mm.
people in the industry, but also there are third parties providing data and how many downloads is this company getting every day, and the company might say, hey, don't listen to that data. So you kind of have finding a more finding a way to navigate the data
Mm.
is harder because there
Mm.
is so much of it.
Yeah. Interesting.
Do you
And
think
what's
that we
really
can
true.
get to a time where maybe we are out of jobs? And I'm reading more articles about some of these AI models becoming really good at picking stocks, even better than the best human practitioners. Are we talking ourselves out of jobs here?
Look, if we're talking about trading, maybe, right? Renaissance has had a
Yeah.
pretty incredible track record
Yeah.
over the last 20 plus years. So if we're talking about trading and you don't care about taxes and all you want to do is
Mhm.
trade, yeah, honestly, yeah, maybe they can. I mean, Citadel, I think, has built a pretty incredible business in trading from nothing. Um, so I think that's completely possible. If we're talking about, so if you're a trading shop that charges 2 and 20, yeah, I think that's going to be a tougher business model. I
Mhm.
think if you're thinking about optimizing for the long term, riding through volatility, buying when you have conviction, um, I would say I hope, is probably all I can say that that business model has more legs. But you know, as we've discussed several times now, AI is still in its infancy,
Yeah.
and where it goes, I don't know. But I know that I'm a better analyst with it than without
Yeah.
it.
Yes. It-
100%. And we try to do the same, Ashim. We're trying to
absolutely.
leverage it. We don't have a massive team, but like it
But
helps a lot
it's
with the
terrific. Look,
research.
It
Yeah.
yeah,
actually helped
technical
me
due
with these
diligence.
questions and learning about you, Ashim.
I wouldn't be surprised. I think it's great at that. I use it regularly for research. I use it in meetings with companies, and they might say in
Hmm.
passing, "Hey, we just hired a guy from Google to do this," and blah blah blah. And I
Mm.
literally would be on my computer, being like, "Who did this company hire from Google? What does he do?" And then I can ask a follow-up question in the
Mm.
meeting and say, "Hey, I noticed he used to run this. How does that relate to what he's going to be running here?" Because he seemed to have some level of success. And so, in the applications for this are material. We ourselves are creating a body of our own internal knowledge that we can then query over time, and we're in the early stages of that. But um, I think a lot of this will get better and better and better. And the question is, does it go at some period, does it go from being an efficiency gainer, whether you're writing code or to one that fully replaces you, I think that's still to be determined. I
Hmm.
think I think the world is hopeful that it is an efficiency gainer. But even if it's an efficiency gainer, that means that there's X amount of, companies then have to decide. And we talk about this with companies. We're like,
Yeah.
okay, so if you're writing 25% of your code from one of these cursor or one of these tools, does that mean you're going to hire less? And they're like, no, it just means we can do more.
More
Or
exactly.
Hmm.
or there's another set of companies that will say, well, it generates 25% of the code, but what you don't see is that, the 10% of that code is wrong, and the time we spend to write that code eats up the efficiency we get in the other 15%, right, where
Uh,
it's generating without errors. So I think that part will improve. That goes back to what we were
yeah.
saying about solving the edge cases. I think that part will improve, but there's a whole cohort of companies who are saying, like, we're using this, we're making everyone use it. We think it's better, but there's balance there. It's not all blue skies and everything's great.
Please company too. Come and dance on our floor.